Hello, everyone out there, and Happy New Year to you. You are listening to Gabe Elton hosting the Austin Report on the one and only Rents Radio Network. Today is Wednesday, January 7th, 2015, and you are listening to me live, I should say, tonight. Today we had another volatile day in the financial markets. After starting the year off for the first time ever, I'll say that again, after starting the year off for the first time ever, for 5 days in a row, stock markets were down. Now, today we had an up day. The Dow Jones ended up 196 points, but that's after falling over 700 points during the first 5 trading days of 2015, which was something that had never happened before in the history of the stock market. The NASDAQ closed up 51 points. Oil was up 52 cents. Gold and silver have been really impressive of late, especially when considering the downward pressure that we've seen in oil. Gold ended down $7, but it still remains above $1,200, currently sits at $1,216. Silver was an unch today, meaning it didn't go up or down, but it still remains above $16, and it's currently trading at $16.55. So once again, Happy New Year to all of our listeners. I think 2015 is going to be a wild ride out there, so buckle your seatbelts. Those people, those owners of gold and silver, I believe, are going to be vindicated in a big way for 2015. You know, let's face it, the last couple of years have been really tough for gold and silver buyers. But the good news is that we believe that this current correction is coming to an end. And in case you haven't noticed, things are quickly changing out there. And for those of you who don't know me, my name's Gabe Elton. I'm the sales manager of Austin Rare Coin and Bullion. We're a coin company located here in Austin, Texas. We've been in business since 1989. I personally have been in the precious metals industry since 1999, and I hope to share some of that experience and insight with you here tonight. For those of you that do know me, you know that I sit in every other week for Charlie McGrath of WideAwakeNews.com, and have been for several years now. I've been a guest of his and a sponsor of his probably for the last 5 years now. Now, some of the things that we'll cover here tonight is going to be a continuation of my last show, in which I covered our precious metals outlook for 2015. And by the way, that precious metals outlook, that report is currently available via our website. You can get it by visiting www.austincoins.com. All you have to do is sign up on our homepage for the report, and it will be delivered to you via PDF. Now, the last several weeks, however, have been so action-packed. So many things are happening in such a short amount of time, and there's so much news coming our way that it's nearly impossible to continue where I left off from the last show. And that's not because of a lack of information, but it's because of a lack of time on tonight's show. It's too much information to cover in such a short amount of time. In fact, I got cut off during the last show. And in fact, 95% of the material that I want to cover here tonight not only supports our outlook for 2015, but it's a perfect segue into what has happened since then that only makes our case stronger. Now, we're going to cover the declining price of oil tonight, what we think that's telegraphing. We're also going to talk about several other factors that we think point to a major economic collapse. Now, you know, you hear these Chicken Littles that have been talking about economic collapses for years, and everyone says, when is it going to happen? Well, the fact is, it did happen, and it happened in 2008. And the fact is, the response to the collapse of 2008, which is the government's version of quantitative easing, has only made things much worse. And those of us who never stopped preaching that an economic collapse is right around the corner have only been able to do so because the government's reaction to the first collapse that we all warned you about, and I'm sure many of our listeners have warned others about, was never fixed. In fact, it's only been made worse. And the chickens, the proverbial chickens, are coming home to roost. And we think that it's coming home to roost in the mid to short term. So what is mid to short term? 2015 to 2016. We think that this is going to quicken and get much worse. And hopefully some of you will take some of the knowledge that we have shared together tonight and use it to your advantage and actually become proactive and do something about your financial future by adding more gold and silver to your holdings. One of the first things that I wanted to point out is an article that I ran across on CNBC, of all places. It's not an ordinary article. In fact, I ran across it on David Morgan's website, silverinvestor.com, and he pointed out this particular article and linked over to CNBC. And the reason why I say it just wasn't any old article is that a regular visitor to CNBC would not be able to see this article. No, this article was only for paid subscribers. Now, luckily they offer a trial period where all you have to do is give your email address. So I did sign up. I wanted to see what this article was about, and I wanted to see what they had to say. Now, even knowing what I know, and even being in this industry for as long as I have and studying economic indicators for the better part of 15 years, probably longer than that, I think the chart that is included in this article is probably the most important indicator of what's to come that I have seen in recent history. And what it is, it's a chart of total margin debt versus GDP. And that particular indicator is at its highest levels that it's ever been over the last 85 years. And margin debt, so what margin debt is you can borrow money based on the money that you have in your stock account to buy more stocks, which is all fine and dandy. However, you are going to pay interest on that margin debt. And as long as stocks go up, it's not an issue. But it's when the stocks begin falling and those margin calls begin that a snowball turns into an avalanche. And that is one of the reasons why it's the most important indicators out there. And anytime that margin debt creeps above 2%, history shows that a severe recession or depression follows. And by the way, this isn't just margin debt, it's margin debt versus GDP. But over the last 25 years, this has only happened 3 times, where margin debt versus GDP has been over 2%. And the only other 2 times over the last 25 years that this has happened was in 1999. That metric reached 2.5% right before the crash of 2001. And then it creeped up above 2% once more over the last 25 years, and it hit 2.4%. Now, when did that happen? Right before the crash of 2008. Right now, that metric is the highest that it's ever been in 85 years. It currently sits at 2.91%, which is the highest recorded level since 85 years ago, 1929, right before the Great Depression. And here are a few quotes from that article. I'm going to go over this. And just remember, as I go over this, this isn't a conspiracy website that's printing this material. This is coming from CNBC. Now, albeit this is the paid version of CNBC, you can't just go to CNBC and find this article. You have to be a registered user. In other words, it's not for the sheeple. But here we go. The article is entitled, "This Chart is a Ticking Time Bomb for Stocks." And it starts off by saying the last 6 years for the U.S. stock market have been an indomitable buying orgy fueled by the Federal Reserve's zero interest rate policy, causing the S&P 500 to triple in value. One metric, though, says it may have gone too far. Borrowing to buy stocks, as measured by the NYSE margin debt figures, ended 2014 at its highest level relative to the size of the U.S. economy since 1929. In absolute terms, it's the highest ever. So, percentage-wise, it's the highest since 1929. In absolute terms, it's the highest ever. And they quote a fellow named Alan Newman, who sent this data to customers of his Cross Currents newsletter last week. And he says, if this doesn't count, then we might as well throw everything we ever learned about risk away, because there is none. The manias of 2000 and 2007 now both look like small potatoes by comparison. This is total insanity. As noted in Newman's chart, going on with the article, buying stocks on margin peaked in 2007 before the popping of the housing bubble, as well as in March 2000, exactly when the NASDAQ Composite's frenzied tech boost ended, causing share prices to be cut in half. While, too, often ignored by the masses, this indicator has a storied history among long-time market data crunchers. It was, after all, buying stocks on margin that was the single cause of the infamous crash of 1929. So, did you just hear that? And I'll read it to you one more time. It says, while often ignored by the masses, this indicator has a storied history among long-time market data crunchers. It was, after all, buying stocks on margin that was the single cause of the infamous crash of 1929. Now, who said that? You didn't hear that from Gabe Elton. You didn't hear that from Charlie McGrath. You didn't hear it from Michael Snyder of the Economic Collapse blog. That came from CNBC. And it coincides with all of the information that we've been seeing, with all of the information that we've included in our latest report, along with another important article written by Michael Snyder entitled 10 Key Events That Preceded the Last Financial Crisis That Are Happening Right Now. And Snyder starts off the article by quoting Bill Gross. He just recently put out a warning. You know, he was the largest fund manager on the planet until he left PIMCO. And here's what he has to say about what's going on. He says, when the year is done, there will be minus signs in front of returns for many asset classes. The good times are over. And, you know, that's one of the things that I asked in my 2014 outlook is, are the good times really over for good? Well, he ended the letter by saying, and so that is why at some future date, at some future Ides of March or May or November 2015, asset returns in many categories may turn negative. What to consider in such a strange world? High-quality assets with stable cash flows. Those would include treasury and high-quality corporate bonds, as well as equities of lightly levered corporations with attractive dividends and diversified revenues, both operationally and geographically. With moments of liquidity having already been experienced in recent months, 2015 may see a continuing round of musical chairs as riskier asset categories become less and less desirable. He goes on to say, debt supercycles in the process of reversal are not favorable events for future investment returns. Father Time in 2015 is not the babe with the top hat in our opening cartoon. He's the grumpy old codger looking forward to his almost inevitable Ides sometime during the next 12 months. Be cautious and content with low positive returns in 2015. The time for risk-taking has passed. So the biggest fund manager in the world, or previous biggest fund manager in the world, believes, and who knows, maybe that's why he left PIMCO in the first place, that the good times are over and that the time for risk-taking has passed. What does that mean when the billionaires, the big guys in the room are preparing for total collapse, and he's not the only one. Warren Buffett has withdrawn $50 billion from the stock market. George Soros is in a position to profit from gold and silver going up. The people who are in the know are making moves, and they're doing it now. And that's what we recommend our clients do, is to get in before the market movers get in. Because you and I don't move markets. Bill Gross and his institutions move markets. And those institutions are looking for the exit signs. You can tell because the CEOs of those institutions, and based on their actions, not necessarily what they say, but what they are doing, shows that they are preparing for a complete and total collapse. And Michael Snyder asked the question, why are Gross and so many other financial experts being so negative right now? And Snyder says, it's because they can see what is happening. They can see the patterns that we saw in early 2008 unfolding again right in front of us. And he includes the following 10 key events that preceded the last financial crisis that are happening right now. Number one, a really bad start to the year for the stock market. And he said during the first 3 trading days of 2015, the S&P was down by a total of 2.73%. There are only 2 times in history when it has declined by more than 3% during the first 3 trading days of a year. Those years were 2000 and 2008. And in both of those years, obviously, we witnessed enormous stock market declines. Indicator number 2. Very choppy financial market behavior. In general, he says calm markets tend to go up. When markets get choppy, they tend to go down. And I pointed that out myself. When you see a market going up 100 points one day, down 200 points the next, up 300 points the day after, those are indication of a market that has reached the top and that is about to turn. And that is exactly what we have been seeing in the financial and stock markets. And he posted a chart that shows the Dow Jones Industrial Average and how it behaved from the beginning of 2006 to the end of 2008. And then you can look at the chart and you can see that it looks exactly like what happened between 2006 to 2007 and how it played out coming into 2008, right before the last market crash. And the chart looks eerily familiar. And he goes on to say, I also mentioned that it's important not to get fooled if stocks soar on a particular day. And this is very interesting, the 3 largest single-day stock market gains in history were right in the middle of the financial crisis of 2008. That's important. The 3 largest stock market gains in history were right in the middle of the financial crisis of 2008. Indicator number 3 is a substantial decline for 10-year bond yields. And he says when investors get scared, there tends to be a flight to safety as they move their money to safer investments. We saw this in 2008. It is happening right now. In fact, Bloomberg just recently put out a report saying that bond yields have dropped to low levels that are absolutely unprecedented. He says, Bloomberg says, taken together, 10-year bond yields of the U.S., Japan, and Germany has dropped below 1% for the first time ever. That's not good news, they say. The rock bottom rates, which fall below 0 when inflation is taken into account, show that investors think we are going nowhere for a long time. Now, that's not Michael Snyder. It's not Gabe Elton. It's not Charlie McGrath. That is Bloomberg. Indicator number 4 is the price of oil is crashing. And oil is right around $48 a barrel right now. But back in June, it was over $106 a barrel. And as Snyder has so eloquently pointed out, there is only one other time in history that the price of oil has fallen by more than $50 in less than a year. And guess when that was? It was 2008, right before the Great Collapse. And so as I mentioned, you can say, someone like myself who has been talking about this for years, you could say, what a Chicken Little, a guy who's always talking about the next collapse is around the corner. Well, guess what? We were right in 2008. We are still right today because the problems have never been fixed. All right, Gabe Elton here with Austin Rare Coin and Bullions, doing the Austin Report on the one and only Rinse Radio Network. As I mentioned, give us a visit. You can reach our website at www.austincoins.com. You can reach us directly by calling 1-800-928-6468. We'd love to help you. And one thing that you're going to find from us compared to some of the other box stores, if you will, our point-and-click stores on the internet, is we really try to speak with you, find out your goals and objectives, and try to structure a portfolio that will help get you where you would like to be. And I think some of the information that you will find with our company is second to none. You're going to find that it's information that you're not going to hear elsewhere. And I think in the long term, you will find that information to be priceless. So make sure to give us a call. Visit our website, visit our YouTube page on which we'll post this radio show once we get it downloaded and up to video. So thanks again for listening. Give us a call. Let us know if we can help you. www.austincoins.com. So getting back to where we left off, we were saying the price of oil has dipped below $48 a barrel, another indicator that was happening right before the last financial crisis. And in fact, the only other time in history that oil has fallen by $50 in less than a year was 2008. And one of the things that I need to apologize for is that I have been comparing the similarities of all of the counterparty risks that are involved with derivatives. And that's kind of a broad statement, so let me back up. So I've been saying that this is very comparable to the subprime crisis that happened back in 2008, where there are derivatives. Back then, there were derivatives based on subprime loans. When the housing values started to fall and people started to have foreclosures, well, that subprime loan market started to collapse, which triggered derivative losses, and that's one of the reasons why Lehman Brothers is out of business today. And I've been comparing the counterparty risks involved with the derivatives on the price of oil to the collapse of subprime, and how that the subprime collapse triggered the financial calamities that we experienced in 2008. And in fact, it is much worse than I have been explaining it. And this is from David Morgan of silverinvestor.com. He says the amount of debt that is carried by the fracking industry at large is double what subprime was in the real estate fiasco of 2008. In summary, we're looking at an explosion in potential that is greater than the subprime market of 2008 because, number one, oil and energy are the most important sectors out there. Number two, the derivative exposure is at least double what it was in 2008. And number three, the banking sector is much larger and much more fragile, and we have less of an ability to weather the storm. So it is much worse than the subprime crisis that we went through in 2008. The counterparty risks are worse, the derivatives are larger, the banks are more fragile, the system is more interconnected, and we have less of an ability to weather the storm. So number five, another indicator that has happened right before the last financial crisis is a dramatic drop in the number of oil and gas rigs in operation. And during the fourth quarter of 2014, 93 oil and gas rigs were idled, and it is being projected that another 200 will shut down this quarter. That is also something that happened right before the last financial crisis. Another thing that happened, number 6, is the price of gasoline took a huge tumble. That happened back in 2008 as well, even though there was nothing to celebrate. And Michael Snyder goes on to say, in short order, millions of people lost their jobs and their homes. So a low gas price, and he posts a chart, and you can see it is exactly as it looked right before 2008, the fall in prices, is not something to celebrate. It signals very bad news for the overall economy. Indicator number 7, a broad range of industrial commodities begin to decline in price. And it says, just like in 2008, what we are watching unfold on the global stage right now is exactly the same thing. From nickel to soybean oil, plywood to sugar, global commodity prices have been on a steady decline as the world's economy has lost momentum. That's from CNBC. Global commodity prices have been on a steady decline as the world's economy has lost momentum. Guess what commodity hasn't been on a steady decline? Gold and silver. Obviously, from 2011 through 2014, as I mentioned at the start of the show, it hasn't been a good time for gold and silver investors. In fact, many of us are wondering if we were right. Many of us are wondering if we're doing the right thing. Well, I think gold and silver forecasted what was about to happen in oil, and I've since reached a bottom and started to turn around. And oil is forecasting what's about to happen to the Dow Jones. And I think it will soon reach a bottom and turn around. But one thing that hasn't been falling with the rest of the global economies, or the rest of the global commodities, rather, are gold and silver. And I think that's the strong thing that I pointed out at the beginning of the show that I think is very appealing, is in the face of all this declining prices amongst commodities, especially oil, gold and silver have actually been going up. Gold is up 2.4% for the year. Number 8, a junk bond crash. Just like in 2008, this is Michael Snyder, we are witnessing the beginnings of a junk bond collapse. He goes on to say that in recent weeks, we have seen investors start to bail out of a broad range of junk bonds. And that is something else that happened in 2008. Number 9, global inflation slows down significantly. And it goes on to say that price inflation, so this gets me here, is the central bankers will come out and tell you that they want 2% inflation per year. That means they want all of your money every 50 years. They're openly admitting that they want all of your money every 50 years at a 2% inflation rate. But their worries are that all across the world, that inflation isn't happening. And that's the same thing that happened in 2008. And the last one is a crisis in investor confidence. Just before the last financial crisis, the confidence that investors had that we would be able to avoid a stock market collapse in the next 6 months began to decline significantly. And guess what? This is something else that is happening once again. And it goes on to show a crash confidence index that's published by Yale. And they point out that it reached its all-time low both for individual and institutional investors in early 2009, just months after the Lehman crisis, reflecting the turmoil in the credit markets and the strong depression fears generated by that event, and is plausibly related to the very low stock market valuations then. And that index has been dropping dramatically. In other words, and as he says, are you starting to get the picture? Are you starting to get the picture? This is, it's like a broken record. We've heard this verse before. We know the words to this song. But Americans have such a short memory. And I'm not preaching to you, which would be preaching to the choir. I'm preaching to your friends, your family, your relatives who don't understand the severity of what is happening right now. I'll close out the show on the other side of the break. Just a little bit further to go, and thank you for sticking with me. A lot of good information coming on the backside of the break here. All right, Gabe Elton here with Austin Rare Coins and Bullion, bringing you the Austin Report. Once again, visit our website at www.austincoins.com. Give us a call directly at 1-800-928-6468. So, as I've covered with you guys, and like I said, I might be preaching to the choir here, but this is important information that hopefully you'll share with some of your friends and family. The picture that we ought to be getting from all of this information is that the good times are really over for good. We fully expect this financial catastrophe to occur in the short to midterm. I mean, 2015 to 2016. And I believe personally that it's game over. It's game over for the way of life as we know it. And you can go all the way back to my report that I put back out in 2014, our 2014 outlook that I put out in January of last year. And in that report, I pointed out that the Chinese economy was now the world's largest, and that the rest of the world had come to the conclusion that they didn't need us any longer. I added that they know how to do math, and that our debt was mathematically impossible to repay. They know that. The rest of the world isn't stupid. And that they were moving away from the dollar. That you look at the population of China, you look at the population of India, you look at the energy production from Russia, and you look at the establishment of this new BRICS bank, and it's very clear that moving forward, the rest of the world doesn't need us. What they certainly don't need is the U.S. dollar continuing to be the world's reserve currency. And in that report, I put one particular sentence in there that said the rest of the world was moving away from the dollar as the world's manufacturing, banking, and gold were all moving east to Asia. And the way I made that prediction was rather easy, is that people don't understand the magnitude of our debt. 1,000 seconds ago was 16 minutes and 40 seconds. 1 million seconds is 11 days and 13 hours. 1 billion seconds ago, it was 31 and a half years ago. 1 trillion seconds is 31,688 years. Our debt, which is 18 times that, just topped $18 trillion. If you counted to 18 trillion and it took you 1 second between each number, you would be counting, and it's impossible, but you would be counting for 570,384 years. It's impossible. It's ridiculous to even think that this can continue, and the rest of the world knows it. And so it's not hard to say that the manufacturing centers, the banking centers, and that all of the gold was heading east to Asia. And so one thing that's happened pretty recently that I think is very, very peculiar regarding my 2014 outlook and some of the information that I included in it is that the action that we've seen in the gold markets versus the reported inventories of GLD do not match up at all. Now, those of you that don't know, GLD is an ETF, exchange traded fund here in the U.S. where you can own paper silver, but they are supposed to keep in their deposits gold for every share that they have outstanding. So one would assume that since gold was down 1% in 2014, that the inventory in GLD would have declined by 1%. And one would be wrong. Inventories were drained by 10%. So to put that in generic terms, 10 times the amount of gold left GLD inventories, then the price of gold declined. And so the question is, where was all that gold going? And Turd Ferguson put out a recent report that touches on the subject, and it's entitled GLD Drain Continues in 2014. And some of the more important parts of the article says, it should come as no surprise that the alleged inventory of GLD fell by another significant percentage in 2014. After having begun the year with an inventory of 798 metric tons, the GLD wrapped 2014 with an inventory of just 710 metric tons, a decline of 10.95%. So he asked, how much is 87.41 metric tons? Well, it's 2,810,000 ounces. In fact, it's over that. Or in other words, 2,810,296 1-ounce gold eagles. That if you were to stack them together, the stack would be 11,000 feet high. That's how much gold left the GLD last year, even though the price of gold only declined 1%. He goes on to show that it would be 7,026 100-ounce bars. But guess what? the Asian market in Hong Kong and Shanghai and the Chinese government does not accept our 100-ounce bars. They have to be sent to Switzerland and reassayed because they only accept kilo bars. So he says, where did it go? First, it went to Switzerland, where it was reassayed and then recast into 87,410 of these. And there's a picture there of a kilo gold bar. Then shipped off to points east and gone for good. And guess what happened just today? The CME Group announced the launch of a physically delivered gold kilo futures contract. How nice. CME here in the States is now dealing in kilo contracts, not just 100-ounce contracts. And the kilo contracts, as it says here in their press release, not Gabe Elton's press release, but CME's press release, gold kilo futures will provide global gold market with precise risk management instrument. New product will be specifically tailored for price discovery in the Asian market and physical delivery in Hong Kong. Now, how about that? Where do you think that gold from the GLD went again? Because now all of a sudden we have kilo futures contracts. And from their press release, it says the world's leading and most diverse derivatives marketplace. Read that again. The world's leading and most diverse derivatives marketplace. The CME is branding themselves as. They should brand themselves as the world's biggest crooks. But moving on, today announced the launch of a physically delivered gold kilo futures contract to begin trading on January 26, 2015. This new contract will be listed on COMEX, builds on CME Group's existing suite of precious metals products. You notice it doesn't say precious metals. It's precious metals products that are paper contracts, and will have contract listings similar to the familiar structure of the benchmark 100 troy ounce gold futures contract. And it goes on to say that this is all meant for the Hong Kong physical market. Well, it goes on to say, the Hong Kong physical market serves as the primary conduit for physical gold flow into China and the surrounding regions. The introduction of our gold kilo futures contracts will provide price discovery in this key Asia bullion trading hub to market participants around the world virtually 24 hours per day. So, do you think the gold is moving eastward? Do you think the manufacturing is moving eastward? Do you think the events in the Ukraine are heating up? Which, by the way, I saw a very good video that was translated into English of Russia's economic minister, who is a direct advisor to Putin. And boy, does he get what's going on. He called the Ukraine a puppet state of the United States and basically said, you've been ravaging Donbass, but if you go down to Crimea, we're going to do to you what the Americans did to Libya. And things are heating up there. Things are happening that many of us have been warning about for decades. And they're getting worse, and it's getting worse quicker. So I would recommend anybody that has the financial ability to do so, add to your gold and silver holdings. The most important thing is to get started. And to be perfectly honest with you, unless you're dealing in large amounts, more than $20,000 worth, it doesn't really matter what it is that you purchase. The most important thing is that you purchase it, and purchase it soon, and get your hands on the physical. Because even if, let's say, you're waiting for a price to fall, guess what? Premiums are going up. In other words, the amount that a dealer has to pay to get a coin or bar is rising. Even in the face of falling prices during 2014, we saw premiums go up. So if you're waiting for prices to fall, you're probably going to be paying the same as you will now, because product is relatively easy to get. Mints are gearing up for 2015 material. January, there's normally no log jams in January. And all of us know, as things get worse, physical metal gets harder to get. However, if you plan on a strategy, if you are looking to be able to buy gold and silver, move in and out in gold and silver in complete privacy, when I say complete privacy, I mean without giving your personal information to a coin dealer, your social security number, and without us having to be reporting those transactions to the government, give us a call. Other coin companies normally aren't going to tell you how to get around that. Give us a call. Now, of course, that doesn't mean that the IRS and taxman doesn't want to know about your profits, but what it means is if you follow our advice, we won't be the person telling them for you. We can teach you more about the implications of confiscation, whether or not it's important to you. If it is important to you, we can point you in the right direction and get you gold coins and silver coins that have the best protections from government intervention. We can also share with you, if there ever was an economic collapse where you needed to barter with gold and silver, which gold and silver coins are going to be the best coins to have in a barter type scenario. So many things that you're going to find from us that you aren't going to find from the average coin guy. Give us a call. You can reach us directly at 1-800-928-6468. You can visit our website, www.austincoins.com. From there, you can go to our Learning Center. We also have a YouTube page. Again, this video of this show will be uploaded there within the next few days. We've got a lot of, in fact, the radio show host that you heard before me from the X22 report, you'll see a lot of his videos on our YouTube page because we like his videos. And as we like them, it'll show up in a rotating list on our page. So big fan of all the truth tellers out there. I'll give a shout out to Charlie McGrath, again, for allowing me to host this show on a bi-weekly basis. But we have been a supporter of alternative media for quite a long time. AustinCoins.com. Look forward to hearing from you guys.